Hello and welcome to chapter 16, where we talk on this chapter about pricing. Although the chapter title is Pricing and Credit Decisions, I'm going to focus primarily on pricing due to the fact that small businesses are not expected to offer credit to their customers, primarily due to the fact that most consumers have credit at their disposal through banks and credit card companies like Visa or Discover. So we're just going to really hone in on pricing in this chapter. And so the chapter slides that you may have seen in Blackboard and may have looked at are going to look a little bit different from these. Primarily focus on this chapter video review for any type of preparation for the quiz. So let's talk about pricing. We'll talk about the cost and demand factors when setting a price. We'll briefly talk about break-even analysis, and we will talk about several pricing strategies. It's a relatively short chapter since we're only primarily focusing on pricing. But pricing is a very, very important aspect of any small business. If an owner of a business, the entrepreneur who's starting the business, doesn't get pricing right, there's a high likelihood that the business is not going to be as successful as it could be if the pricing strategy was well thought out. So when we're taking a look at pricing, we know that there's the very real possibility that we set the price too low and therefore don't make as much revenue or profit as we should. We could also, on the other hand, price it too high and scare customers away, which again would result in a loss of revenue and a loss in net profit. So profit and demand are really related to how well we can sell and how well we can retrieve revenue from the sale of our goods and services. Here, again, credit is just an agreement for a buyer and a seller to negotiate between, and then the buyer buys and pays at a later date. We're not going to talk about credit, though, as far as our discussion in this chapter. When we are talking about pricing, though, we do have to, as a business owner or an entrepreneur, we have to know what our costs are. We have to know our total cost, as well as what makes up those total costs, the variable cost and the fixed cost. So as you develop a pricing strategy for your business, one of the things you have to keep in mind is what are the total costs on a monthly basis, and how will my pricing recoup not only those costs but also provide me some level of profit. From your economics classes, you should have hopefully you remember what elasticity of demand looks like. So this is the degree to which prices change, or demand changes according to the change in price. So when you take a look at something that has an elastic demand, demand changes significantly when there is a change in price. So in other words, let's say you have a product A that you have priced at $20, and at $20 it has a relatively stable demand of 30 units per month. When you increase the price to $25, because this has an elastic demand, you're going to notice that demand will decrease significantly because it's elastic. The demand will fluctuate according to price. On the other hand, if you have an item that has relatively inelastic demand, a change in price does not change the level of demand. So this would be something like a very good example would be gasoline. We buy gasoline at $2 a gallon, which, lucky for us, right now it's right around $2 a gallon. But if the price would go up to $3 a gallon, the demand basically stays the same. So items with inelastic demand tend to be staple items like gasoline, bread, milk. In times of crisis, like we're going through right now, we find that even toilet paper has an inelastic demand. But that's not normally the case with toilet paper. When there's not a pandemic going on in the world, toilet paper tends to have a fairly elastic demand. People will buy it when it's on sale, but they won't pay a higher price for it, even though it is a necessity. But let's talk about pricing. Let's talk about what a small business owner or entrepreneur really needs to think about when they're trying to determine the price level of their products and services. So for me, here's what's important. Four primary elements that need to be considered when pricing your products. You need to look at the competition. You need to figure out what the economic conditions and demand are in the market. What is the position of your firm in the market as to how consumers perceive it? And you have to know cost plus pricing. So I'm going to go over these four elements in detail. So in competition, here's what we need to consider. What does the competition charge for their products and services currently? In other words, if you're going into a market with a brand new business and there are competitors, what are their prices? And are the competition's pricing looked upon as too high or too low by customers? So how do customers perceive the competition's pricing? Is it generally looked at as being too high, too low, or just right? And then what is the level of quality of the competition's products and services? You'd also probably want to look at what's the level of service that they deliver at those prices. So once you have a really good idea of how the competition is pricing and what they're offering for their prices, then you might look at another element. You might look at the economic conditions and the demand. What are the general economic conditions? Are we in an expansion? Are we in a contraction period of the economy? So as I speak and as you listen to this, because of the pandemic, we are actually in a contraction. So customers are not going to be out there buying products that are really expensive. They're also not going to be out there buying products that have a relatively inelastic or an elastic demand. In other words, I'm not going out and buying a lot of products that are luxury items. Most people right now are only buying the bare necessities because the economy is in a contraction period. It's shrinking. Now, as soon as the pandemic's over, I really look for the economy to go into a major expansion. When there's a major expansion, then people will start buying luxury items and items that are not needed for daily use. So you have to take a look at your products and figure out, is this a luxury item or is this an item that actually people have to have? Is it a need more than it is a want? For instance, medical equipment, which is what my business was focused on, has a demand that is fairly constant. Therefore, the expansion or the contraction of the economy didn't really make a difference. But if you were going to open a business, let's say, and sell ice cream in the park out of a cart, ice cream cart, then you're probably right now not wanting to go start that business. You're going to probably wait until the pandemic is over and people are out into the parks. Well, actually today the governor announced that parks are closed, all the state parks. So I think you get the gist of this. Is the demand for your product and services elastic or inelastic? So how sensitive are your products to price as it applies to demand? If you raise your products' prices and the demand is constant, then it's relatively inelastic. Is demand for your products sustainable? Is this a short-term or a long-term type of product? The demand is going to be there over the long term. You want to look at your position in the market. How do you want customers to perceive or position your business? Do you want them to look at your business as a low price leader? Or do you want to be looked at in the market as a company that offers quality products at a higher price? So jewelry stores, usually, most jewelry stores are going to be looked at as the latter, higher quality at higher prices. So that has a little bit to do with how their pricing strategies will pan out. However, if you want to be as I was in the market, you want to be looked at as a low price leader, then of course that's going to have a big impact on how you price. Most of your products are going to be priced lower than the competition. And then finally, cost plus pricing. Most businesses use this type of strategy when pricing their products. Now, they look at the prior three elements that I just discussed, but then they try to determine, okay, what is the price that I want to actually charge the customers? And they will have this idea in their mind, and a lot of time it's industry driven. Some industries, a 40% markup is pretty standard. Some industries, a 60% or even higher is pretty standard. In the fashion markets, fashion clothing has a fairly high markup when it's priced at retail. This excludes places like TJ Maxx or Marshalls. But if you go to Macy's, Saks Fifth Avenue, those fashion items have a relatively high markup associated with them. But let's say, for instance, and I'll use the example that you see here below. If the product cost me $20 and I want to get 40% markup out of it, the simple way to do it is cost plus pricing, which is cost divided by 1 minus the desired markup. Okay? So 20 divided by 0.6 equals $33.33. So a $20 product that I want to get a 40% markup out of will have a retail price of $33.33. I want to make sure that these prices cover my operating expenses and any type of price reductions that I might have, that I'm still getting some type of profit out of it. But I will tell you that most businesses, this is how they price. They use it, and most, especially retail. And I've been in retail at several different levels. And markup pricing or cost plus pricing is really where how the strategy lays out. You've probably seen this in economics, and that's the break-even analysis, where we get some type of idea of at what price does the firm break even based on the sales of products. And if you took a look at, I'll come back to this in a minute, but if you took a look at the graphs at this point that I'm showing in the middle here, where it goes from blue to green, this is the break even where actually losses are end and profits begin. But what's really critical at this point is to make sure that you're covering your cost. And let me go back. Most manufacturers will use break-even pricing. Small businesses tend not to use this type of pricing. If you would have asked me what my break-even pricing was, I would have had no idea. I sold thousands of different products at different price levels. Therefore, I had no idea what the number would be to break even. But I did have an idea of what my revenue needed to be. So if I knew that my revenue needed to be at a certain point in order to cover my cost. And I typically, in my business, my markup was somewhere between 45 and 65%, depending on the product. I would look at that range, and then I would look at my competition, and I would try to set my price somewhere in that range, looking at the competition and the demand. But break-even analysis is important for businesses because you want to cover your cost. Where do you break even? But again, as I said earlier, this is primarily used in the manufacturing industry, where manufacturers maybe are producing 1 or 2 items, and they know exactly what they have to produce and what they have to sell in order to break even. So the sales volume at which total sales revenue equals total cost is your break-even point. Okay, anything then above that break-even point is where profitability starts. And I think that's pretty much what I wanted to talk about there. Now, last thing that I want to talk about is selecting a price strategy. And we talked about where most businesses are what they're going to be using. They're going to use cost plus pricing. But I do want to go over, I'll go clockwise starting at the top. You've probably heard some of these terms before. Penetration pricing is where you are going into a new market for you, but the market already has competitors in it. So when you go into this new market and there are already competitors out there, you may price your products at a lower price in order to penetrate the market and gain some market share from those competitors. In other words, if you would go into a market that already has competitors and you go in at a higher price than them, it's going to be very hard in order to penetrate that market. Just the opposite of that is skimming pricing. Skimming pricing is if you go into a market that has no competitors. In other words, you have a brand new technology or a brand new product or service that no one has offered before. In that case, you can offer a higher price because you have no one competing against you. And skimming means that you're skimming the profits off the top because you're gaining a lot of profit because your product is priced higher than average. And then once competitors enter the market, you can lower your price to meet or beat their prices. Follow the leader pricing simply means that whatever the leader in the market is charging, you charge as well. You're just following their lead. And a lot of companies will do this, especially if they can offer comparative products and comparative service. And it will turn out to be pretty successful. But if you cannot offer the service and the quality that the leader is offering, then you may have to price yours lower than them. Dynamic pricing means that the pricing is different by customer. In other words, a customer comes in and let's say you sell men's suits and it's custom fit, and you have to make that suit according to the size of the customer. It's going to be different for every customer depending on what fabric they choose, what buttons they choose, how big the person is. So dynamic pricing means that it's constantly changing. What the market will bear basically means if the market is paying a certain price out there today, then and they're buying a lot of it, then that's what you would sell it for. If you went on to eBay right now, you can find toilet paper selling for $5 or $10 a roll. That's what the market will bear. The market will pay that right now. Now, after the pandemic is over, consumers are not going to be paying that. But what the market will bear means that you will price your products at what the market is willing to pay for it currently. Prestige pricing is a pricing strategy that you want to charge where you want your customers to believe they are getting higher quality. Now, you can only do this if you offer higher quality. But if you have a high-end product or service, then you would want the pricing to reflect that. Let's say you had a restaurant and you had gourmet food and each dish was carefully prepared by the chef. Well, a higher price would be indicative of that type of service and that type of product. If you charged $1.99 all you can eat and the chef prepared it, it's going to lose its perception of quality from the consumer, and you're probably going to lose your shirt in the process. Price lining is where you have a product line that has different price levels. A really good example is the iPhone. Right now, iPhone comes out in the iPhone 11, iPhone 11 Pro, an iPhone 11 Max. All three are priced differently. They have different features and sizes. I believe the iPhone 11 only has 2 cameras. The Pro and the Max have 3, and the Max has a larger size. But that is that price lining is, you've got the same product basically offered at 3 different price levels, so you can attract more of the market that way instead of having just one product at one price. And then finally, variable pricing is where you charge different prices per customer. In other words, a customer comes in and buys X amount of a product, you charge X amount for that product. Then a customer comes in, maybe they will contract with you to buy X amount over a period of 3 months. Then you might give them a lower price because they are saying, I will buy this much from you over the next 3 months. And that price may be a little bit different. It's almost like bulk buying. And that variable pricing comes into play in many businesses as well. So those are some of the major pricing strategies that are out there. And I think that you should now have a pretty good idea of how a business goes about in pricing their product. And there are the key terms for the product. If you have any questions, let me know. But that was pricing. Don't forget to take the short quiz on pricing after you review the video and all the material. And I hope you have a great day and you're staying safe out there. Take care and have a great day.